In 2006, a 44-story office tower in downtown St. Louis sold for $25 million. Last year, that same building changed hands for $3.6 million. That is not a typo. That is a 98% destruction of value on a commercial asset that a bank once considered safe collateral. Now scale that math across the 21 trillion commercial real estate market in the United States, and you begin to understand the size of the hole that is being concealed from you right now. This is not a prediction. It is arithmetic. And the arithmetic is telling a story that the mainstream financial press, the regional banks, and the federal regulators are all desperately trying to delay you from reading. What you are witnessing is not a correction. It is not a soft landing. It is a structural repricing of the foundational collateral layer that holds the American banking system together. And the banks are not writing down those losses because the moment they do, the math reveals something that the entire regulatory apparatus has spent 3 years pretending does not exist. More than 600 regional banks in the United States are currently carrying commercial real estate loans on their books at values that bear no resemblance to what those properties would actually sell for today. They are functional zombies, kept alive by accounting forbearance and regulatory patience, both of which are now running out at the same time. To understand why this matters to you specifically, you have to understand how the system is actually plumbed. The American banking system does not operate as a single entity. It operates as a pyramid. At the top, a handful of mega institutions, J.P. Morgan, Bank of America, Wells Fargo, hold diversified global balance sheets with enough capital to absorb significant losses. But below them, holding nearly 70% of all commercial real estate debt in the country, are the regional and community banks. These are the institutions that lent to local developers, financed the office towers in secondary cities, and extended credit to apartment syndicators during the zero-rate era. They are the ones sitting on the loss. And they are your bank. The institution where your payroll deposits, where your business checking account lives, where your operating capital sits waiting to pay your vendors next week. That is the institution that is currently extending and pretending on billions of dollars in loans that will never be repaid at face value. The mechanism that created this crisis is straightforward, and it was entirely predictable. Between 2020 and 2022, when the Federal Reserve dropped the federal funds rate to near zero and flooded the economy with liquidity, commercial real estate valuations inflated at a rate that had no historical precedent. Borrowers took out short-term floating rate debt at 3% because the carrying cost was negligible and the assumption of perpetual appreciation was universal. Syndicators raised capital from retail investors, bought apartment complexes at 10 and 12 times their annual income, and built their entire business model on the assumption that they could refinance in 3 years at similar rates. Office landlords signed 10-year leases to anchor tenants who planned their footprints around 5-day work weeks. None of those assumptions survived contact with 2023. The Federal Reserve's hiking cycle, the most aggressive since Paul Volcker in the early 1980s, moved the federal funds rate from near zero to over 5% in less than 18 months. That single policy shift did not just raise the cost of new borrowing. It detonated the refinancing math of every floating rate loan originated during the stimulus era. A building that generated enough income to service debt at 3% is deeply underwater at 7.5%. The debt service coverage ratio, the ratio of a property's net operating income to its loan payments, collapses below the minimum thresholds required by lenders. The loan cannot be refinanced. The borrower cannot inject enough fresh equity to make the numbers work. So the borrower does what rational economic actors always do when the equity is gone. They walk away. They mail the keys back to the bank. They choose the option that limits their further loss. This is not a phenomenon limited to unsophisticated small-time speculators. Blackstone, the largest alternative asset manager in the world with over $1 trillion in assets under management, defaulted on a $270 million commercial mortgage-backed security in 2023 tied to a portfolio of Finnish office buildings. Brookfield Asset Management, one of the most sophisticated real estate investors on the planet, defaulted on loans totaling over $750 million tied to Los Angeles office towers, including 2 of the city's most prominent downtown skyscrapers. When firms of this caliber hand back the keys, it is not because they lack sophistication. It is because they ran the numbers and determined that the equity is mathematically zero. The smart money is leaving the building, literally. The banks cannot afford to receive those keys. That is the central perversity of where we are. When a borrower defaults and the bank forecloses, accounting rules require the bank to mark the recovered asset to current market value. If a bank lent $200 million on a tower that now trades at $40 million the moment foreclosure is complete, the bank must recognize a $160 million loss. That loss must come out of the bank's capital reserves. For a regional bank with $2 billion in total assets, a loss of that magnitude does not create a problem. It creates an insolvency event. So instead of foreclosing, the bank grants an extension. They modify the loan terms. They lower the interest rate slightly, waive a covenant, buy the borrower another 12 months, and hope that either rates fall enough to make refinancing viable or that a buyer emerges willing to pay a price that keeps the collateral above the loan balance. This strategy is called extend and pretend. It has a long history in banking crises as a short-term stabilizer and an even longer history as a mechanism that transforms manageable problems into catastrophic ones. According to data from the Mortgage Bankers Association, over $1.5 trillion in commercial real estate loans are scheduled to mature by the end of 2026. That figure represents not just a single wave, but a compression of maturities that were extended once, sometimes twice, from their original due dates. The extensions are now expiring simultaneously. The banks that granted those extensions are now facing the same bad math they were trying to avoid 2 years ago, except the properties have continued to deteriorate, vacancy rates have continued to rise, and interest rates have not fallen enough to make the refinancing viable. The wall of maturity is hitting its peak right now, and there is no more road to kick the can down. The office sector is the epicenter, but it is critical to understand why the office collapse is fundamentally different from any prior commercial real estate downturn. In every prior cycle, whether 1990, 2001, or 2008, office vacancy rose because the economy contracted and demand temporarily fell. When the economy recovered, tenants returned, vacancies normalized, and asset values recovered. That dynamic required only patience and capital. What is happening now is categorically different. The vacancy rate in downtown San Francisco has exceeded 36% as of early 2026, a level not seen in any major American city since the Great Depression. New York City's midtown vacancy has risen above 22%. Chicago's Loop sits at over 25%. But this vacancy is not cyclical, it is structural. It reflects a permanent shift in how knowledge work is organized, driven by the full maturation of remote and hybrid work infrastructure. The demand for the square footage simply does not exist in its prior form. These buildings are not waiting for an economic recovery to refill. They are functionally obsolete in their current configuration. The conversion math does not pencil, which is the second layer of this structural problem. Converting an office tower to residential units sounds like an elegant solution, and city governments across the country are offering tax incentives to encourage exactly this. But the economics of conversion are punishing. Office floor plates are typically 20,000 to 30,000 square feet per floor, designed around a central core of elevators, bathrooms, and mechanicals. Residential units require perimeter windows for light and air and plumbing runs that office buildings were not designed to support. The cost of converting a single office floor into apartments routinely exceeds $500 per square foot. On a 500,000 square foot building, the conversion cost alone approaches $250 million. In a market where the building sold for $30 million, the conversion is more expensive than a ground-up development on an empty lot. This is why, despite 2 years of government incentive programs and press releases, the actual conversion pipeline remains a tiny fraction of the vacant space. The buildings sit, and while they sit, they continue to deteriorate, continue to drain cash from owners who cannot sell and cannot convert, and continue to slowly poison the balance sheets of the banks that lent against them. The contamination is spreading from the office sector into multifamily, which was supposed to be the safe harbor of the commercial real estate universe. During the pandemic boom, real estate syndicators, many operating with minimal track records and maximum leverage, raised billions of dollars from retail investors to acquire apartment complexes across the Sun Belt. They deployed an underwriting model that assumed annual rent growth of 15 to 20%, used floating rate bridge loans with 2-year terms and options to extend, and planned to sell the stabilized assets into a rising market within 36 months. Every single variable in that model has inverted. Rent growth has not just slowed. In markets like Austin, rent prices have actually declined year over year as the massive apartment construction boom of 2021 and 2022 delivered hundreds of thousands of new units into a market where demand growth has stalled. The bridge loans have reset to floating rates that are now 400 to 500 basis points higher than the original underwriting assumed. And the exit market for these assets has essentially closed because institutional buyers require going-in capitalization rates of 5.5% to 6% to deploy capital, and the sellers are priced at cap rates of 4% based on what they paid. The bid-ask spread is not a rounding error. It is a chasm that is preventing any transaction from clearing. The consequence of this standoff is a wave of distressed apartment foreclosures that is just beginning to hit the market. According to data from MSCI Real Assets, distressed commercial real estate sales reached their highest quarterly volume in over a decade in late 2025. But the more important data point is that this volume represents only the leading edge of the distress, the deals where the math was so broken that extend and pretend was no longer viable. The bulk of the distressed inventory has not yet reached the market because banks are still extending, still pretending, still hoping that the Federal Reserve will cut rates aggressively enough to bail them out. That hope is colliding with an inflation dynamic that makes aggressive rate cuts politically and practically impossible without reigniting price pressures that remain above target across services, shelter, and insurance categories. The insurance market is a sector of this crisis that is not getting adequate attention, and it is accelerating the repricing faster than any other single factor. Major carriers, including State Farm, Allstate, and Farmers, have either withdrawn from or dramatically repriced their exposure to property risk in states including California, Florida, Louisiana, and increasingly Texas and Arizona. The stated reasons are climate-related risk and reconstruction cost inflation, both of which are real and both of which reflect structural changes rather than temporary conditions. But the financial impact on property owners is immediate and severe. In coastal Florida markets, property insurance premiums that were $8,000 per year in 2019 are now $40,000 to $60,000 per year for comparable properties, assuming coverage is available at all. When insurance is unavailable through standard carriers, property owners are forced into state-run insurers of last resort, which carry their own solvency risks and coverage limitations. For a commercial property owner, this insurance shock is a direct hit to net operating income. If your annual insurance cost triples, the cash flow the building generates falls by an equivalent amount. That reduction in cash flow directly reduces what a buyer will pay for the building because commercial real estate is valued as a multiple of its income stream. A $100,000 increase in annual insurance expense at a market capitalization rate of 6% reduces the value of the asset by over $1.6 million. On a portfolio scale, across thousands of properties simultaneously experiencing insurance repricing, this mechanism is destroying trillions of dollars in collateral value with a speed and a breadth that the banking system was not designed to absorb. The residential market is not insulated from this pressure. It is absorbing it through a different mechanism. The lock-in effect that has suppressed inventory for 3 years is finally fracturing. Homeowners who refinanced at 2.75% or 3.25% during the 2020-2021 window have been rationally unwilling to sell and surrender that rate, knowing that purchasing a comparable property would require financing at 6.5% to 7.5%, effectively doubling their monthly payment for the same housing. This frozen supply dynamic has kept median prices nominally elevated, creating a false impression of market stability. But life does not pause for mortgage rate differentials. Divorce rates are rising, job relocations are not optional, estate settlements require liquidating inherited properties. Debt service stress is forcing sales that the sellers would prefer to avoid. According to data from the National Association of Realtors, active listing inventory rose over 20% year over year in early 2026, with particularly sharp increases in markets like Austin, Nashville, and Phoenix that saw the largest pandemic-era appreciation. That inventory is hitting a demand side that has been functionally frozen by affordability constraints. The affordability numbers are not an abstraction. They are a structural barrier to transaction volume. The median home price in the United States stands at approximately $420,000. At a 7% mortgage rate with a 20% down payment, the principal and interest payment on that home is $2,230 per month. Add property taxes averaging 1.1% annually, or roughly $385 per month. Homeowners insurance averaging $200 per month in low-risk areas and significantly more in high-risk markets. And the total monthly payment exceeds $2,800 before a single utility bill or maintenance expense. To qualify for that mortgage under standard debt-to-income guidelines of 43%, a household requires gross income of approximately $78,000 per year. The median household income in the United States is approximately $75,000 per year. The median buyer cannot qualify for the median home. That is not a market under stress. That is a market whose transaction mechanism is broken at the fundamental level. The institutional investor dynamic is adding a layer of forced supply that the market has not previously had to absorb. The Wall Street landlord trade, the strategy of acquiring large portfolios of single-family rental homes in Sunbelt markets like Atlanta, Phoenix, and Charlotte, was premised on a model of rising rents, low interest rates, and an exit via securitization or portfolio sale to another institutional buyer. All three pillars of that model are now compromised. Rent growth has stalled in the target markets. The cost of servicing the acquisition debt has risen dramatically for any portfolio originated after 2021. And the institutional buyer base for large single-family rental portfolios has contracted sharply as the required return hurdles have risen. Invitation Homes, the largest single-family rental REIT, disclosed in its most recent earnings that it was actively pruning its portfolio, selling properties in markets where the yield did not justify the capital employed. When the entity that built the trade begins unwinding it, the inventory implications for local markets are significant and not priced in by the broader housing data. The banking system's exposure to this compounding pressure is the story that regional bank equity prices are beginning to tell, though the bond market has been pricing the risk for longer. The KBW Regional Banking Index has underperformed the broader market significantly over the past 18 months, and the underperformance is concentrated in institutions with known commercial real estate concentrations. New York Community Bancorp, which absorbed a significant portion of Signature Bank's assets following that institution's failure in 2023, disclosed in early 2024 that it was setting aside dramatically larger loan loss reserves against its commercial real estate portfolio. The stock fell over 60% within days of that disclosure. That is not a market overreaction. That is the market recalibrating its entire prior assumption about what was on the balance sheet. The playbook that NYCB provided is now being studied by every analyst covering every regional bank with material commercial real estate exposure, and the list of institutions fitting that description is long. The credit rating agencies are beginning to move. Moody's placed several regional banks on negative watch in 2025, specifically citing commercial real estate concentration risk. A credit rating downgrade for a bank is not merely a symbolic event. It triggers covenants in the bank's own funding agreements, raises the cost of wholesale borrowing, and in some cases forces the sale of assets to maintain capital ratios. Forced asset sales into a market with no buyers create exactly the mark-to-market pressure that the extend and pretend strategy was designed to avoid. The sequence: deteriorating collateral, loan extension, rating agency scrutiny, covenant trigger, forced sale, price discovery, is the mechanical sequence of every commercial real estate credit cycle that has preceded this one. The difference is the scale of the underlying problem and the degree to which the accounting forbearance has delayed the recognition event. The municipal finance system is the third layer of this structural unraveling, and it connects the commercial real estate distress directly to the fiscal health of the cities that house these assets. American cities fund a substantial portion of their operating budgets, including police, schools, infrastructure, and debt service, through property tax revenue. Property taxes are assessed based on the value of the underlying property. When a 44-story office tower sells for $3.6 million, the city must eventually reassess the property at its current market value and collect taxes on that reduced valuation. In a city like San Francisco, where office values have declined by 50% to 70% across much of the downtown core, the property tax revenue implications for the city budget are severe and are only beginning to be reflected in the assessments. San Francisco is currently projecting multi-year budget deficits measured in the hundreds of millions of dollars, driven in significant part by the collapse in commercial property values. This fiscal pressure feeds directly back into the viability of holding urban real estate. When a city faces budget pressure, it pursues the paths of least political resistance: service cuts and tax increases on remaining property owners. Both responses accelerate the flight of businesses and residents from the jurisdiction, further eroding the tax base, which deepens the deficit, which requires further cuts and increases. This is the urban doom loop that has played out in Detroit, in Cleveland, in Hartford. It is now beginning its rotation through cities that were considered immune to this dynamic a decade ago. The municipal bond market is the financial instrument through which this urban fiscal stress is transmitted to the broader capital markets. Pension funds, insurance companies, and individual investors hold trillions of dollars in municipal bonds, many of which are backed by the tax revenues and creditworthiness of cities experiencing exactly this fiscal deterioration. The credit spreads on municipal bonds issued by major cities with significant commercial real estate exposure have been widening, though they have not yet reached levels that reflect the full scope of the underlying risk. When they do, the mark-to-market losses on the institutional portfolios holding these securities will create their own wave of forced selling and repricing. The Federal Reserve sits at the center of all of this, as both the architect of the conditions that created the problem and the institution with the most to lose from a disorderly unraveling. The hiking cycle that was necessary to control inflation also detonated the commercial real estate market. The Fed knows this. They have read the same loan loss data that the regional bank analysts are reading. They are attempting to engineer a soft landing not just for the consumer economy, but for the $21 trillion commercial real estate complex and the $2 trillion in regional bank balance sheet exposure attached to it. That is an extraordinarily difficult needle to thread. Cutting rates aggressively enough to allow refinancing at viable levels would require reducing the federal funds rate to somewhere in the 3 to 3.5% range, which implies a level of monetary accommodation that is inconsistent with bringing inflation to its 2% target in the near term. Keeping rates elevated long enough to fully achieve that target means the refinancing wave hits its peak while the cost of capital remains above the level at which most of these distressed loans can be serviced. There is no clean path through this. There is only a choice of which part of the system absorbs the loss and over what time horizon. If the loss is recognized quickly and completely, the banking system contracts sharply, credit availability collapses, and the real economy experiences a severe but relatively short duration adjustment. If the loss is socialized gradually through inflation, monetary expansion, and regulatory forbearance, the adjustment extends over years. Purchasing power is eroded for everyone who holds dollars, and the institutional integrity of the financial reporting system is compromised in ways that make the next cycle more dangerous. Every prior cycle has demonstrated a clear institutional preference for the second path. The dollar takes the hit, so the balance sheet does not have to. That choice has profound implications for where capital should be positioned. In the phase of the cycle we are currently entering, which is the late-stage extend and pretend phase transitioning toward forced recognition, cash and short-duration instruments carry a premium. The $6 trillion sitting in money market funds is not a sign of irrationality. It is a rational response to an environment where the risk-adjusted return on illiquid assets is deeply negative once the actual loss probability is incorporated. The institutions holding that cash are waiting for the forced selling that creates the true clearing price, the level at which distressed assets generate a return sufficient to compensate for the risk. We are not at that level yet. The bid-ask spread between what sellers are pricing and what buyers require is still wide because sellers have not yet been forced to accept reality by the exhaustion of extension options. The data centers and the industrial warehouse sector are the telling counterexample within the commercial real estate universe. Both categories are experiencing robust demand, low vacancy, and rising rents. Data center demand is being driven by the artificial intelligence infrastructure build-out, which requires massive, power-dense facilities with redundant cooling and connectivity. Industrial warehouse demand is driven by the reshoring of manufacturing and the permanent expansion of e-commerce fulfillment infrastructure. These categories demonstrate that the commercial real estate crisis is not a reflection of broad economic weakness. It is a structural repricing of specific asset types that have been rendered functionally obsolete by changes in how the economy organizes work and distributes goods. The capital that was deployed into office towers and retail malls is trapped. The capital that can find its way to data centers and industrial parks is performing. The crisis is about the misallocation of the prior cycle, not the absence of real economic activity. What happens next is a mechanical process, not an event. The maturity wall of $1.5 trillion in loans does not expire on a single day. It expires across every quarter of 2025 and 2026, creating a rolling series of distress events, each one individually manageable in isolation, collectively unmanageable as a system. Each quarter will bring another tranche of loan maturities that cannot be refinanced at current rates, another round of extend and pretend negotiations, another set of banks forced to set aside additional reserves, and another increment of credit tightening that slows the broader economy. The delinquency rate on commercial mortgage-backed securities has already risen to levels not seen since 2013 and continues to accelerate. Special servicer transfer rates, the rate at which loans are transferred to special servicing because the borrower has breached a covenant or missed a payment, are rising at their fastest pace since the immediate aftermath of the 2008 crisis. The shadow banking sector is the final and least visible layer of this accumulated pressure. Non-bank lenders, including private credit funds, mortgage REITs, insurance companies, and debt funds, stepped into the commercial real estate lending market aggressively after the post-2008 regulatory framework constrained traditional bank lending. These entities now collectively hold an estimated $800 billion to $1 trillion in commercial real estate debt, much of it in the form of mezzanine debt and preferred equity that sits below the senior loan in the capital stack and absorbs losses first. Unlike regulated banks, these entities do not mark their portfolios to market on a regular basis. They report returns using internal valuations that reflect what they paid, not what they could sell the loan or asset for today. This smoothing of volatility, referred to in the industry as volatility laundering, has allowed private credit funds to report consistent positive returns through the most severe commercial real estate repricing in a generation. That consistency ends when investors request redemptions that require actual asset sales at actual market prices. We are beginning to see the first generation of these redemption pressures materialize, with several major non-traded REITs limiting investor withdrawals to manage liquidity. When you cannot get your money out of a fund, the fund's stated valuation is a theoretical number, not a real one. The process that is unfolding is not a prediction of catastrophe. It is a description of mechanical inevitability. Loans mature. Collateral must be valued. Capital must be allocated to absorb losses. Credit conditions tighten in response. Economic activity slows. The Federal Reserve faces an impossible dual mandate in an environment of structural stress: policy decisions are made, each of those decisions has consequences that cascade through interconnected markets. The timeline is not days or weeks, it is quarters and years. But the direction is not in dispute among the professionals who are actually working through the loan files, setting the loss reserves, and managing the special servicing queues. The system is not collapsing emotionally. It is repricing structurally, and the repricing has much further to go before a genuine clearing level is found. The data will tell you when that level is approaching. Watch the transaction volume, watch the bid-ask spread. Watch the credit spreads on regional bank debt. Watch the pace of extension requests hitting special servicers. The story is in those numbers. It has been there for 2 years. It is getting louder every quarter. If you want to track this data as it develops, this channel will continue to follow the credit cycle as it moves through each of its phases. Subscribe so you do not miss the next phase of this analysis.